Welcome to Alternative Investing. I'm Andrew Bell, and here with me, the irrepressible, the one and only regular Friday co-host on this show, David Kaufman, president of Westcourt Capital. Great to have you back.
Good to be back.
On this show, we explore investment concepts outside of the traditional realms of stocks and bonds. It's for investors like you, sitting on cash, looking for alternative places to put your money, places not in the public markets, but in funds or products that fly a little more under the radar. Now, this can be bewildering. There are a lot of choices, such as real estate, private equity, or hedge funds. On today's show, we're talking about real estate, but not the trusts this time. Today, it's real estate for growth. I mean, David, can you kick off, just explain the difference between the two concepts, investing for yield and investing for growth in real estate?
Sure, and this concept actually applies across the whole investing universe, where in the end, total returns is really what matters. Total returns are made up of two things. It's distributable income or other types of distributions. It's capital appreciation, also known as growth, or a mix, of course, of the two, which you'll find in a lot of publicly traded securities. And so when an investor approaches any individual investment and says, is this for me? What they're really looking at are their investment horizon, their need for cash. Are they going to live on this investment? Their time horizon in terms of how long do I have for this to grow? How much would I like it to grow, of course? But also there's the need for certainty and risk tolerance. And the longer you have to wait to have total return through growth, the more risk in some ways that implies that you're assuming more risk because you're not getting paid today. Mm-hmm. You're waiting to get paid more tomorrow, hopefully in a tax-efficient way.
Now, when we think about investing for growth in real estate, what kind of assets are we talking about?
Right. We're not talking about, at least we're not talking today, about typical residential real estate. Mm-hmm. Well, remember that when we had our conversation a couple of weeks ago with Greg Roman when we were talking about REITs, we're talking not about individual end-user homes, because then you have to deal with things like homeowner sentiment when you're establishing value, as opposed to, say, some multiple of rents that are derived from commercial properties.
Just the housing market's not logical, in other words.
Not necessarily. You have to pay what what's more than what someone else is willing to pay for a reason that may not be entirely fiscally rational. And so we're really talking here about commercial properties, the same kind of properties that someone operating a REIT would be taking a look at: offices, industrial, commercial, and apartments, which of course are residential, but you're talking about apartments that are put together on a rental basis.
Now, we've got three main factors driving the price of these assets.
Sure. Whenever you're taking a look at any investment, but particularly with real estate, you start with the macro analysis, then micro, and then you have to get really specific. So in a big picture, you need to have a macro thesis that's based on supply and demand. So you might say, is this asset, that, for example, an apartment building, located in a geographical area that I like? So Whitby, Ontario is fabulous because the population is getting older, people are retiring, they're moving to Whitby. I want to go to Whitby and I want to buy an apartment building. And then you get to a micro thesis, which would be something along the lines of, this particular building is undermanaged, it could be underpriced, it's on a street that I think is an up-and-coming street. You get more micro than that. But then the absolute requirement is that you have patience. And the reason that you have to have patience, to go back to the famous quote from Keynes, is that the market's irrationality will always outlast my solvency. Mm-hmm. And so that it really speaks to two things: having patience to let your thesis bear out, and of course achieving diversification, which we talk about every week, which is don't try and do this with a single asset. Try and do this through a professional fund manager who is taking your money and then diversifying it among a group of assets.
Just remind us, will you, why real estate is a classic alternative investment.
Yeah, so going back to why real estate in the first place, there are sort of four key advantages to investing in real estate as an alternative. So the first is that it typically has a low correlation to the public markets, which means that you're diversifying yourself out of, say, the stocks that you own. And we'll be able to discuss with our guest today that that's not always achievable if you have to invest in publicly traded real estate, but that is commonly understood to be a major driver. Moderate capital appreciation and consistent, predictable returns are the next two. And of course, you can turn the knob on that one. You can reduce the returns to get more appreciation, or you can increase the returns, as we see with the REITs, to get potentially lower appreciation, but still some appreciation over time. And that leads into the fourth, which is pretty much sure across the board, which is that inflation historically has been an excellent inflation hedge. Because
real estate's been.
Correct.
Yeah,
and that if you invest in real estate, you can have an expectation, even if you pay out the rents, for example, in a REIT, that you would expect that the capital appreciation would keep up to inflation more or less across the board. And historically, that has proven to be the case.
We've got to take a break. We're going to stick with this theme. Our look at alternative investments continues. We're going to be talking about the value that can be found in real estate. Up next, David and I will talk to an expert in the field, Jeffrey Olin, CEO of VisionCap. Welcome back to Alternative Investing. I'm here with David Kaufman, president of Westcourt Capital, and David and I have been talking about using real estate for growth as an alternative investment. Now we're going to talk to a specialist in the field, Jeffrey Olin, president and CEO of VisionCap. He's here to tell us how his company invests in real estate. Great to have you here.
Thank you.
Could you give us a quick summary? What does VisionCap do?
VisionCap is a manager of 3 funds that are focused on the real estate sector. We have an opportunistic approach involving long, short strategies. We do take concentrated positions selectively in our best ideas, and we seek to be active investors where appropriate to add value to our investee companies.
So you'll give management a hard time sometimes?
We try not to give them a hard time, but contribute to their effort.
And what's performance been like since inception for these funds?
We've had a pretty strong track record. We launched, we're now into our 3rd year, well into our 3rd year, and we are up, I think, 87% is the number since our launch, July 2nd, 2008. So we've significantly surpassed all the benchmarks, whether they're broad market, hedge fund, or real estate index benchmarks.
Okay, so you launched in July of 2008.
Yeah.
I think we can all remember that was a moderately turbulent time in the history of the markets. And notwithstanding the timing, you're up 87% since then. So, and yet we have everybody rushing for yield. Like, what's going on?
Well, this is not a new phenomenon, and it certainly goes through cycles and resurges. I mean, you recall the income trust era where there was a fever for yield, as you put it. And entities were going to the bank to borrow money to pay their distribution. So you got to be careful with yield, for sure. But real estate, the fundamentals are solid. Supply and demand, as I watched your earlier part of the segment, is in balance. We've had limited new development. The economic platform in Canada is fairly solid. The government's done a good job. We now have employment levels back to where they were before the recession. So the fundamentals are sound, and the real estate companies are well managed. They don't have too high debt levels, and so it's a fairly good environment for real estate securities.
I mean, we hear about the Canadian consumer with this debt load that amounts to 140% of income, a record high. I mean, isn't that an overhang on the real estate market?
Well, there's some concern on the single-family market for sure that's having an impact. We don't have much exposure to the single-family market directly, but certainly to the extent it's impacting consumers' purchasing power, it may have an impact. We haven't seen it. Certainly the most direct impact would be in the retail arena, and so far the retail names have held up quite well.
Okay, so this show is called Alternative Investing, and we always talk about the purpose of considering alternative investments. Decorrelation from the public markets is a big one.
Indeed.
Now, you typically trade in publicly traded companies. So how do you avoid being over-correlated to the public markets at large?
Yes, we invest in equity and debt securities. Part of the answer is we can be long and short. We tend to focus on value as opposed to yield. We focus on total return. So yield can be a component of it, but we're also looking for capital gains. And the correlation of our fund to the index is about half of what the correlation of the real estate index is to the stock market index broadly. So that's about 90% correlation in the index, and we're about 50% correlation. So we've managed to do it by stock picking, by, as you put it, macro, looking at supply and demand factors, by asset class, by region, and finding those opportunities in asset classes with great management teams.
You sometimes short.
We do. And we tend to use our shorts more often as a hedge, so we might go long one name that's relatively undervalued and short one that's relatively overvalued.
So to make this simpler to understand, can you give us an example of how a process worked for you?
Sure. Well, the largest holding we've had in our fund since we launched, and anybody that cared to listen to us would have found that the largest holding in our fund were the common shares of a company called Parkridge Lifestyle Communities, Inc., an interesting business, manufactured housing community business. They're like apartments, but better in the sense it's more pure cash flow. And we were telling folks, even though they didn't pay large yield, that there was tremendous value, was trading well below its net asset value, and our view was validated on the 4th of October. BC Pension Fund announced the proposed acquisition of Parkridge at a price of $7.30, a premium of 30% to where it was trading.
PRK on the TSX.
PRK on the TSX.
Okay, so just to understand, so that's interesting. So they had rents coming in. It's just that what they did with the rents was different. They didn't say, okay, we're going to pay this out to our investors. They reinvested it for growth.
They reinvested it for growth in both income producing directly in terms of new acquisitions, as well as expanding some of their current properties, and they've done a great job.
When you're looking for undervalued assets, what do you look for? The worst house on a good street, to use an analogy?
We look for the net asset value of the real estate, the bricks and sticks, and how that net asset value compares to the share price. Is it too high or too low, the share price relative to the value of the asset? And we're looking forward. We're not looking at net asset value today, but where is it going to be tomorrow?
Actually, I'm always curious. We know that the cliche is when Starbucks moves into an area, the area is on the way up. If you're looking, say, at a retail property, what are the signs you look for in an area?
Well, certainly traffic flow is one. What is the traffic flow in the area? What is the income profile of the consumers within the trade area? What is the competition of that center? You might have great trade area and great income support, but if there's 4 shopping centers all competing, maybe it's not the best. You look for position of influence. You look for strong management. You look for aligned management. So there are a number of factors. There's not one single factor.
So does that mean that on a macro level there might be entire geographies that you would just stay away from because you don't like the story?
Absolutely. We started a macro view. What asset class do we want to be in? What region? And that's one of the beautiful things you asked about compared to real estate. You could be the best office guy in Toronto, tenant relationships, political relationships, brokerage relationships. But if the Toronto market is getting soft, you say, I should do this in Calgary. Well, it might have taken you a generation to develop that expertise in Toronto. It's difficult for you to replicate that in Calgary or Vancouver. If we're bullish on Alberta apartments, we can be long Boardwalk. If we're bearish on Toronto apartments, you can be short, TGA, Transglobe, REIT. You can do that in 5 minutes with low entry and exit costs with best-of-breed management.
What about I just want to run this past you. The thesis we've heard that small-town Canada could be in for a boom as the seniors move there, if they have low crime and good hospital facilities. Do you ever look at things like that, regional centres?
Absolutely. Believe it or not, there's a couple of REITs in Canada that are focused almost exclusively on Fort McMurray, which has been a boom town. So, we've looked at regional plays, and we're not shy to invest in them if we think that the supply and demand metrics are compelling and the management is strong.
Okay, so at the fund management level, talk to us about IFRS, the International Financial Reporting Standards rules that have come in, and how has that affected you as a manager?
It's material. IFRS, for those that are not familiar, what it will do is it will change the accounting standards. Historically, we've had book-based accounting. If you've bought a building 40 years ago, it's depreciated on your books, so the value may show low on your books, but the market value may be significantly higher. And IFRS will capture that difference. And so some of these entities that are not well followed by analysts, maybe because they don't do corporate finance business or they don't trade very, very often, may be under the radar screen. And IFRS will highlight that value and will help pinpoint that differential.
A more accurate NAV, in other words?
More accurate NAV, exactly.
Now, let's have a look at Parkridge. PRK, obviously that one jumped, and obviously when you see a pension fund, it's a classic pension fund type asset. Not a bad jump there, and that stock's shortly going to be taken off the market. You have one other stock idea for us, EDU. Tell us about this one.
EDU is a recent new investment in terms of disclosure. We are the largest public shareholder, and I am on the board of directors. Again, we're looking, this is a long-term opportunity. We are looking at a 2 to 3 year minimum time frame on this. They're consolidating the childcare industry in Canada, which is the only Anglo-Saxon country in the world where consolidation and professionalism of the industry hasn't taken place, and there's a huge demand exceeding supply imbalance, and Olin is the first Canadian player to pursue this goal.
This was controversial in Australia, I think, when the childcare industry started being consolidated by private
Well,
companies.
it wasn't controversial in terms of the operations.
No.
What was controversial is the largest company in the world basically went from about $100 million in debt to over $1 billion of debt right at the wrong time during the credit crisis, and so they put on too much debt, and that caused the company to have some challenges, but the operations have been solid, and the Milken family has bought some of their assets, and largest operator in this space in the world is Michael and Lowell Milken, and other Morgan Stanley bought some of their American assets, and the founder of Macquarie in Australia bought some of the Australian assets.
Now let's remember that we are talking here about investments, not speculative trades.
Absolutely.
Long term.
Absolutely. Anything we do. We do some short-term trades, but that's not our focus. We are looking at opportunities that typically take 18 to 24 months to help surface the value and liquidity.
Good stuff, Jeffrey. Thanks very much indeed.
Thanks for having me.
Jeffrey Olin, President and CEO of Vision Capital. Well, coming up, it's time to hear from you, the viewers. Last week's show on managed futures got a lot of you talking. David will be answering your email questions next on Alternative Investing. Welcome back to Alternative Investing. I'm here with David, President of Westcourt Capital. Time now to answer your emails for David. Here's the first one, Dave, from Alex. The show last week on managed futures was informative. Helped me understand a different type of strategy to include in my portfolio. What I am unclear on is, should I sell more of the commodity-based Canadian equities in my portfolio to include a managed futures strategy?
That's a good question. That's a complicated question, because what it implies is that there's a connection between the commodity-driven equities in Alex's portfolio and the strategy of managed futures that was discussed last week.
And the idea is there isn't.
There isn't.
Yeah.
And I know this is a broken record, but it's very important to remember that alternative investments from an asset allocation point of view are meant to decorrelate yourself. And so then the idea here is that if you believe that managed futures is an interesting way to derive absolute returns and decorrelate yourself from the public markets, the fact that they may, as a tool, use commodity-based elements does not mean that you should be going long or short the commodity-based equities that you already own in your portfolio. So I would look at the two as completely separate. If you believe in being long on commodities from an equity perspective, go for it. But you might also want to consider the managed futures approach, which is not necessarily long and approaches it in a very different manner.
In other words, commodity prices can be tanking, but if there's a trend, the managed futures guys hope to make money off that.
That's right, but that doesn't mean that it's a good hedge either against your equity portfolio. The concept is that the correlation is close to zero. It's not meant to be negative, so I wouldn't play one against the other.
It's interesting. You got me thinking now. It'd be fun to find some equities or groups that had a negative correlation to commodities. Hard to think of something.
Yes, but it is possible, of course, to hedge your way out of growth at all, which is not the concept. When you're doing your asset allocation, you're not trying to end up at a zero sum. You're trying to end up with a positive sum.
We've got an email from Adrian in Toronto. Says there appears to be various ways in which to invest in managed futures, whether on my own or through a fund, and with different types of funds to choose from. Can you help me to understand this better?
It's a complicated question. I sat down and I actually made some notes about what does it require to be able to engage in a managed futures strategy, and I ended up with four major ideas: that it takes time, it takes a lot of knowledge, it takes a high degree of sophistication, and more than anything else, it takes discipline, so that you don't pull the pin at exactly the wrong time. Now, it is possible that a do-it-yourselfer out there has those four elements, but it's unlikely that they could do it in the same way that a professional who does that 8 hours a day could do it. And so as a general rule, I would certainly advise that people not enter a managed futures strategy as a do-it-yourselfer unless they're very sophisticated with a lot of experience. then with respect to picking which fund manager that you might be interested in, I would go back to our show on due diligence, which is how do you pick an investment fund of any type. In this case, it's a managed futures fund, and take a look at who's running it, what's the model, what are the risks, how do I get in and how do I get out, sort of the general liquidity principles, and then apply that to any individual fund that you see that runs a managed futures strategy.
Got another email, this one from David. Please advise how a small investor could add managed futures to their portfolio. Portfolio size, 300,000, looking for 20 to 40,000 exposure to a well-managed fund. Most funds seem to have higher limits to entry.
That's true. And David, I'm happy that you emailed us this week, because almost every week we have people saying, well, I'm a small guy, how do I get in? And a lot of the time, unfortunately, the answer is not so fast. Here, though, there are what are called commodity pools, which really are publicly traded managed future funds available in Canada and the U.S. In Canada, two of the big ones that I know of are run by Mann and Bluemont. That doesn't mean that I am proposing that they are the best. I'm just suggesting that those are two of the largest ones. And that would be a way that David could say, I like what I heard. I want to enter this area. I want to diversify among my asset classes. And then but happily now we have a publicly traded option where you can come in at a much lower number than would be the case with some of the other types of funds that we've been talking about.
Right. So this is the Claymore ETF, or what are you talking about? Sorry.
I'm talking about Mann and Bluemont in particular.
Sorry.
Yeah. It's not an ETF. On a future show, I think we will discuss the fact that Claymore will be introducing an ETF for managed futures, but that has not yet
hasn't launched yet. Sorry.
Exactly.
Well, let's talk about next week's show. What's coming up?
Next week, we're going to be talking about mortgage investment corporations, also known as MICs, which are basically mortgage funds. And we're going to discuss what happened in the U.S., why that didn't necessarily happen in Canada.
Because all kinds of garbage got put into mortgage funds in America.
Tons.
Yeah,
And you saw the securitization of bad mortgages lead to the collapse of the entire financial system. And so what we're going to say is, what is it about mortgage funds in Canada that make them potentially a conservative good bet? When you saw what happened in the U.S., we're going to, as a guest, have Rob Goodall from DB MIC to talk about differentiating the kinds of mortgages that are written in Canada in the non-traditional space from the crap that we saw in the subprime market in the U.S.
Well, thanks very much, David.
It's a pleasure.
We're out of time on today's show. We'll be back next Friday at 11:30 Eastern, 8:30 Pacific with another edition of Alternative Investing. Remember to contact us, email us at alternativeinvesting@bnn.ca. Thanks very much. My thanks to David Kaufman of Westcourt Capital. Remember, we do want to hear also suggestions for assets that you think we should look into. David is a specialist in real estate. We were just talking in the break how we could do a whole show on real estate. Remember, get your suggestions into us. And a reminder that Claymore, in the next few weeks, say they plan to launch the first managed futures ETF in North America. Tim Pickering of Auspice Capital will be running that one. Well, thanks very much indeed for watching. Have a great day in the markets, everybody, and have a great weekend.